Hello, everybody. Thanks for tuning in. I'm today going to be talking with Paul Archer, who's a senior manager at Nationwide. I think it's really relevant and interesting topic at the moment, exploring mortgages. There's always a lot going on, but it seems ever more at the moment. Paul, good to see you again. I think it's been several months since we last caught up. And well, what's been happening? House prices still been rising, mortgages still cheap, buyer demand also fairly intense. How long can this go on, do you think?
Wow, that is a. I think that's the question that if anyone knew, they knew the answer to, they would definitely be in a better position than me. But I think, as you alluded to, that Phil, sort of demand has been sort of stronger than we expected through the last couple of years. Obviously, there's been large levels of macroeconomic intervention, with stamp duty, land tax, holidays, which is now starting to be tapered out, which caused a big bump in the market, two big bumps in the market, one in around Easter time when we expected it to be phased out before, and then in June, and we probably expect some sort of bump at the end of September where it finally gets phased out. So we've already seen some signs of a cooling market in the context of that taper, but activity is still relatively strong. So it's tricky to decipher at the moment, particularly how the two main government interventions run out from here: the end of furlough at the end of September and the end of the final end of the stamp duty taper, also at the end of September.
It does just seem there's still a lot of heat in the market, and because because it's been quite an intense summer, there's still a lot of people that are unsatisfied in terms of their housing requirements. And it's exactly the same in the rental market as well. But they can't find anything, they can't buy anything, they can't borrow the money, but they really want to borrow the money because the deals are good. So it's a really challenging time. Do you have, at Nationwide, do you have forecasts? Are you kind of predicting what it might look like come the end of the year? Because, as I say, there is a lot of pent-up demand.
There is, and I think anecdotally, what we're seeing at the moment from the market is a lot of a lack of housing stock coming to the market, which is causing a stored level of demand, even though that demand has fallen as the stamp duty taper has come in. The fewer houses coming to market, and there's still competition for those houses, as the underlying reasons for people to want to move are still relevant, in terms of potentially wanting a bit more space, not needing to live in big urban areas anymore. Those trends are still prevalent.
When I've been often around the country filming, everywhere I've been, north, south, east, west, it's been as busy everywhere, and also interestingly, all price brackets. So there really has been a kind of race for space. But Paul, how are the actual rates decided? Obviously, there's always a lot of jostling for position between the lenders, and you're tweaking products all of the time. And there really are some sensational mortgage products out there, probably better than ever at the moment. But how do you decide on the rates and kind of constantly tweak things? How does that happen?
So there are two main factors that come into mortgage pricing. Firstly is the cost of savings. So lenders will basically only lend, or broadly lend, what they have in the bank to be able to lend. So savings rates at the moment are relatively low. Obviously, bank rate is relatively low. So those two things generally tend to correlate. There are, over the lockdown period, we've seen a lot of people have been increasing their savings. So you see all major lenders have got a lot of money to lend. The second main part is macroeconomic sentiment broadly. So your viewers may have heard of something called swap rates. They are very important when it comes to the price of fixed rate mortgages. And basically, without getting too technical, they are a forward view of where the market thinks that bank rate is going to go. And when you sort of add those two things together, that basically are the building blocks of mortgage pricing. So you are absolutely right in terms of prices for mortgages for people with a lot of equity in the property. Broadly, we mean over 25%, are historically low. I think there was some analysis came out the other day where there's 100 mortgage products all under 1%. A few, even when I spoke to you last, a rate under 1% would have been definitely the outlier rather than the norm. But in terms of,
they can't fall any further, can they? But I guess you start to tweak all of the other elements of the loan, the length of it, the and the arrangement fees and that kind of thing. Do you? Is that?
We haven't seen that. I think there is the reason that arrangement fees are charged in the market is because there is a cost to setting up a mortgage. It's not a free process. There's a lot of work in the background that is done. A lot of very complex work in the background that is done to ensure people can have a mortgage. I think just the one thing would be a positive for consumers is that competition in the market is still high. We've talked about low LTV rates for people with a lot of equity, being unable to fall further. I think that's my personal view, is that's probably largely true. I don't think we'll see those low rates fall further, but in terms of rates for customers with a smaller amount of equity, particularly 90 and 95% LTV mortgages, I think we've over the last month. So if you'd asked me last month, I'd been less bullish on this. But the over the last month, we've seen those rates come in quite a lot, and they're still not to a level they were back in 2019. So there is some potential. We are seeing the competition in the market focus on those rates.
Okay, so who? Obviously, you're lending to a wide range of people, but is there a sector of the market that you are particularly strong at? First-time buyers or second-time movers, or?
Yeah, for Nationwide, we are really focused on first-time buyers. We want to be helping those people onto the ladder. It's part of our societal purpose. Be really strong in there, and for us, making sure that we've got a good market share of first-time buyers would be pretty key, and making sure our propositions are really offering value there. Obviously, at the moment, we're seeing that the number of first-time buyers in the market is starting to dip slightly, but the question for us would be how much of that demand was brought forward into the stamp duty windows, and how much will endure, and we're particularly keen to make sure that it endures in a sustainable way.
Great, that is really good to hear. I'm not an economist, but it feels to me that we're yet to feel much of the kind of financial burden on society of all of the brilliant support packages that were necessary to get us through the pandemic. I'm sure a lot of people viewing this will have had some of those, whether it was furlough or self-employed COVID grants or whatever it may have been. Do you have any advice to those people or suggestions when it comes to making a mortgage application? Does it affect anything? Do you have any thoughts on that?
So the number one consideration for any lender in the market will be that the customers can pay back their mortgage. So we'd be really keen to make sure that their income is sustainable. For Nationwide, I can't speak for the wider market, but for Nationwide, as long as those customers are now back in paid employment and can prove from 1 month's payslip that they have returned to work, then the fact that they are on furlough is largely irrelevant, as long as they've obviously been keeping their credit commitments up to date. Then the market is open and ready to lend.
So has the kind of criteria assessment for lending, has it changed in any way post-pandemic?
No, not materially. I mean, during the the furlough period. I think we saw some tightening of criteria around people who were self-employed, some tightening criteria who people who had slightly irregular incomes potentially.
Okay.
We're starting to see those, that criteria across the market be more open to those customers.
Great.
But I would say I think
that's really positive news. So that's the kind of bottom end or one end, the lender. Can we just talk about the other end, the houses? So you're assessing the lenders, the borrowers, and assessing the houses. I've started over the last 6 weeks. I've heard a lot more stories about houses being downvalued. And that's when I start hearing that always makes me a bit jittery about the marketplace. And is it getting overheated? Surveyors aren't liking it, banks aren't liking it. It worries me. Are you experiencing that?
so. Not at the moment, not at a wider level. There's undoubtedly individual examples of houses being downvalued, and I think there might be a part of that, if I'm being honest, around people having a higher expectations when they are selling their property.
Okay.
We've been through a period of very high demand where a lot of properties were going to best and final offers and were going for well above the asking price. And whether that has changed people's expectations from the seller's point of view is difficult to know. There's two things at play there. We're still house price inflation in August. We've seen just recently with the Halifax index and the nationwide index, so it's still seeing house price growth in August, which was a bit of a surprise given the June tapering down, the second tapering down of stamp duty. So we're still seeing a good level of growth and a good level of underlying demand. But with that said, we've still got some concerns around the future in terms of how is unemployment going to play out after furlough. And it's not a big concern, but nonetheless it is coming into some decision-making processes. So house prices may moderate as a result of those, and I think there will be some surveyors who are thinking about that in the round. And I think it is likely that, given the state of house price inflation at the moment, that it may not continue. So even though we're using the word down valuation and there's some quite scary connotations around that, the potential downside to that may be moderate and just a correction.
It's I mean, I guess that's why it's an interesting topic to follow. It's an interesting market to be involved in, because you never quite know. And the definition of a marketplace is it constantly moves and evolves and sort of adapts to the conditions of the time. Paul, I'm sorry, it's crystal ball time. Can I ask to get any thoughts or opinions you have on what the mortgage lending market might look like into 2022?
So I think naturally, with the amount of support that's been granted to the mortgage market over the last 12 to 18 months, that the market is likely to be smaller in the next couple of years. It is likely to change in the way it's made up. So as we've discussed, it's been a relatively good time to be a house buyer over the last year. I think we'll be slightly more focused on people refinancing over the next year. So we expect that the mortgage market as a whole will be a little bit lower next year, and maybe even the year after that. But the underlying fundamentals will still be good in terms of, and obviously we've got that demand and supply balance to strike. The main thing will be how well the.
Sorry, I don't mean to interrupt, but when you say the mortgage market will be smaller, do you mean there'll be less? You'll be lending less money?
Overall, we're not talking about sort of big decreases in market lending. It'll be largely driven by demand dynamics in the house purchase space, rather than lenders' willingness to lend.
And that's because you've lent an awful lot over the last year, and people have perhaps brought forward their plans.
Correct, absolutely correct.
Got it. Okay.
I mean, the large piece of this will how the economy holds up in the next 6 to 12 months. With, the forward signs are quite strong. But there's potential for right at the start of this. We talked about that lenders have got a lot of money to lend. If we start to see people draw down on their savings balances as they've accrued during lockdown, then that could drag a bit, and it could force up the cost of savings, which will force up the cost of mortgages.
Okay.
And then just any inflationary pressures there may be in the market too, which may force bank rate up, which again may force up the price of mortgages. But like I say, the current view at the moment would be we expect some moderation, but that's largely, as you say, due to the phasing of demand rather than anything that fundamentally attacks the underlying principles of the mortgage market.
Okay. But what is going to happen with inflation? We need to pay our way out of this pandemic and all of the support packages. You're in business to lend money. That's what you want to be doing. You want to be finding ways of doing it. But surely there's going to be some inflation pressure coming, isn't there?
I mean, yes, there is that potential. I mean, the Bank of England will manage that. I think the central assumption will be that inflation will be temporary. We'll see a potential increase in inflation, which will run itself through in terms of prices may rise in the short term, but then will stabilise in the outer years. And again, our central assumption is that the bank rate will stay relatively stable over the next few years, but that is a level of a conjecture which I'm not really qualified to opine on, unfortunately.
Paul, terrific. Very, very grateful for your time. Always insightful to hear the goings on at Nationwide. It's a really interesting time. Good luck with everything. Very much appreciated it.